Hey, what's up, everybody? Welcome back to Investing Sucks. So, a few days ago, I asked you guys to comment some lesser known companies that you'd be interested in seeing me cover on this channel. I had a lot of interesting suggestions. So, what I want to try and do over the next few weeks is cover as many of these companies as I can in a series that I'm going to call Your Company, My Analysis. So, this video is going to be part of that series. Now, I can't promise that I'll get to all of them. Because there are a lot of companies in there. But if you want to ensure that a company you are interested in has a chance of potentially being covered on my channel, then make sure you drop a comment on that community post there. And the point of these videos is really just going to be to give you a high level overview of the business that we're talking about, trying to understand the company at a fundamental level. We'll discuss the industry for a bit as well. And then, as always, do an actual valuation. And then I'd give my personal opinion on a company and whether or not I think it would be a business that I would like to look into further, do a bit more research on, or if it would just be a pass for me and it's one I'm not really interested in looking into any further. So that's really going to be the end result of the videos. I'm not going to outright tell you to go buy and sell it because one, that's a decision that you've got to make for yourself. And number two, I want you guys to use my channel as really just a second opinion or a source of an alternative viewpoint, right? On a specific company, whatever company you're interested in. I don't want you to use my channel as me just directing you on how to make your investing decisions. Now, at the same time, I do want to cover some more well-known companies. So companies that I personally think would make interesting videos, or a company that I'm personally interested in talking about. So those are the two types of videos that you can expect to see from now on. But nonetheless, the video we're doing today is going to be on Telus International. So this is a company I've received many requests for since I've been doing this channel. So today we're finally going to cover them. Okay, so here is Telus International. So I'm going to scroll down and go to their About section so we can get a good idea of what this company actually does. So Telus International, they provide customer experience and digital business services in Europe, North America, Asia Pacific, Central America. So pretty diversified in terms of geography. It offers digital experience solutions such as AI and bots, omnichannel customer experience, mobility solutions, cloud contact center, big data, and then a whole laundry list of different types of IT services that they provide there. So you really want to think of this company like a digital consulting business. It's not really a tech company. It doesn't have tech company level profit margins, as we'll see later, although they do offer a lot of technology related services. I wouldn't necessarily consider them a technology company just because the profit margins are a bit lower. Usually with a technology company, the underlying assumption is that they have much higher profit margins, which leads to a higher valuation that you get with a tech company. So as it stands right now, their core competency is really working with their clients, consulting them on how to leverage these, what they call next generation technologies. So the things that are in that list there, stuff like AI, content moderation, digital customer experiences, which seems to be a big thing as well. So those are really the main areas that they're in right now. Now, if we go to their most recent investor presentation, they do give some good information here that I want to go over quickly. So they do offer a breakdown of revenue by vertical here. And vertical is just a fancy word for saying a different type of industry that a company sells to. So there's technology and games that makes up the vast majority of it, which I think makes sense. I mean, digital customer experiences would probably be pretty important for those types of companies. E-commerce and fintech is another large one at 13%. Communications and media, which is pretty broad there, 24%, and then other is 18%. And then in terms of their revenue growth from Q3 2021 to Q3 2020, it was pretty strong, so 30%, but we'll take a more in-depth look at that when we actually look at their financial statements. And then again, revenue by geography, so pretty geographically diversified there in many different regions. And then another interesting tidbit they point out is client concentration. So they are actually very concentrated, where top 10 clients make up majority of their revenue. So going back to their stock price here, we can see that they became a public company in February of 2021. So that's when they spun out of Telus, the larger telecom company, and became just Telus International. And since then, their stock price it was flat for a bit, but it did actually go up quite a lot to just around $49 a share. And that was in October of 2021. But since then, it's come down pretty significantly, currently at around $31 per share. Okay, now the next thing I want to do is take a look at some valuation metrics and see how they stack up for this company on a historical level. So the first one I'm going to look at is the price to sales. So we can see the price to sales was kind of hovering in the 3.5 range. It then went up kind of around that time period that the stock price peaked, about 4.2. And then it's since come down quite a bit. So we can determine from this that the decline in stock price wasn't due to deteriorating sales or anything like that. It was really just a shift in sentiment regarding this company in particular. Another valuation metric we can look at is enterprise value to unlevered free cash flow. So this is pretty similar. They are a company that's free cash flow positive, so it does make sense to use this metric. And it tells us a pretty similar story. It was kind of flat around this range, 29-30. It then went up a bit, and then it's come crashing down. So again, to me, that points to the fact that there's just a shift in sentiment towards this company, and the decline in stock price is different than a decline in stock price resulting from deteriorating business fundamentals. Although this is very, very short term, we're only talking about 6 months here. That is key information that we can decipher from this. So next thing I want to do is take a look at what financial statement data we do have available for this company. Now, remember, they did get spun out of Telus not too long ago, so we don't really have many years of financial statement data, but let's work with what we have here. So in terms of revenue growth, it has been pretty high, double-digit revenue growth, but because the company was spun out, there is a chance that some of this revenue is just coming from contracts they have set up with Telus, and not necessarily because, the business just offers a superior service, and because of it, they're growing super fast. So that's one thing to keep in mind. And in a few minutes, I'm going to dig a little deeper into that specifically. Their gross margins are at around 22%. So again, that's more in line with what you'd expect with a consulting/service providing company, not necessarily a technology company that would have gross margins in the 80 to 90% range. And a big cost item on their income statement is the actual salaries that they have to pay to their employees. So if we scroll down, we can look at the operating margins. So again, kind of 10% range, which again, that's more in line with what you'd expect with a service providing company. So if we take a look at the balance sheet, what I'm really interested in looking at here is just how much cash they have, and then how much debt do they have relative to that cash, just kind of as a high level overview type of thing. So in terms of cash, they have about 100 million, so 115 million. Current assets are 627 million. Current liabilities exceed current assets, and they are actually fairly leveraged because a big chunk of their current assets is their long-term debt, or the current portion of the long-term debt. So the part of the long-term debt that's due within the next year as of this financial statement filing date. And then they have another 650 million in general long-term debt. Although I'm not as concerned about them being slightly more leveraged than you might want them to be. Again, as we'll get into a bit, they do have some contracts that are in place that are essentially guaranteed revenue for them. Now, if we look at the cash flow statement, this gives you a good picture of kind of how the income statement works and what items get added back, because that can kind of show you the difference between cash flow from operations versus net income. Cash flow from operations, in my opinion, being more indicative of how you get paid back as a shareholder, specifically cash flow from operations minus capital expenditures, which is how you calculate free cash flow. So cash flow from operations is much higher than net income. And the big reason for that is because they're adding back amortization of goodwill and intangible assets. So when this company makes acquisitions of other companies, the companies they're acquiring are, for the most part, going to be software companies. And when you acquire a software company, you're typically going to recognize a lot of intangible assets in that transaction, because that's what makes up most of the value of a software company is the intangible assets they have. Even if it's not specifically software, it could be some other sort of technology company. So that's what's going to lead to that. And I would expect going into the future, intangible assets to continue to be kind of causing a large discrepancy between net income and depreciation and amortization. So then we scroll down, we can look at any acquisitions they made. So they made a pretty big acquisition here during 2020, $1.8 billion. And it looks like they paid for most of it by issuing debt, because they also issued $1.8 billion in debt And then they also issued quite a bit in common stock as well. So there is a bit of dilution in the past 2 years because they issued stock. But again, it is, a growing company, a young company. Usually you expect that to happen. So let's take a look at their actual filings now and get a bit more deeper into this company. So because they were a spinoff, what you want to take note of is the share structure that they have in place, because being a shareholder isn't always just about flipping stocks and making money. It is actually about ownership in an actual business, which means you're going to want to understand what rights you have as a shareholder, because they're not always going to be uniform company to company. So here they're describing this in pretty layman terms. They're saying they have two classes of shares: multiple voting shares and subordinate voting shares. The subordinate voting shares are what you buy when you buy this company on the stock exchange. And the multiple voting shares have 10 votes per share. Subordinate voting shares only have 1 vote per share. And then Telus, so the parent company, and Barring, which is this company, I'm not too familiar with this company and who they are and what they do, but they're the only shareholders that own the multiple voting shares. Telus owns 70.9%, and Barring owns about just under 26%. So from that, you can pretty much decipher that if you do invest in this company, you don't really have control or a say in any matters that get brought to the board, like changes in the board of directors, anything like that, because it's majority owned by Telus. And what you can kind of infer from that is, for me personally, I would imagine that the spinoff did take place, or the reason Telus decided to do it is because they took notice of the very high prices investors were paying for techie type companies, and they knew that if they made Telus International a public company separate from Telus, investors would probably bid up the share prices, because they do tend to be more excited about technology companies. And especially throughout 2021, that was a pretty big theme in 2021. A lot of technology companies, and even in 2020, a lot of technology companies really took off, went up 300, 400% in a year, and became pretty detached from fundamentals. And we've kind of seen an unraveling of that over the past few months, where a lot of those technology companies come crashing down, some of which I've talked about on this channel. But that's just my personal opinion on what I think management's thinking was there. Maybe I'm right, maybe I'm wrong, who knows? So another important thing to note about Telus International, which again stems from the spinoff that occurred, is this one very significant related party transaction. So this is going to be your daily dose of accounting standards for those who are interested in learning this type of stuff. Most people aren't. It is super boring, but I think this would be useful to some people out there. So a related party transaction in the accounting world can either be a transaction with a company or with another individual. And in this case, because Telus owns 70% of Telus International, they are considered related parties because they're majority owned by Telus. And there's a whole laundry list of relationships between company to company or company to individual that would be considered related party. For example, if another individual is related to someone who's on the board of directors, that'd be another example of that. Or if there's a joint venture between two companies, that can also be considered a related party for any transactions between them. And related party transactions are subject to additional disclosures. They have to do a bit more legwork in disclosing the transactions that occur between them. So that's what you're seeing on screen here. So this is significant because, as we'll see, there is something in place that they call a master services agreement. And earlier up in this report, they mentioned that there's a minimum annual spend that Telus sends to Telus International of $200 million per year. But as we can see in this detail here, it's actually been much higher than that. And they talk about the revenue that came from them specifically. So in 2021, $353 million in revenue was coming from this one master services agreement, which is just from their parent company, Telus. Now that's pretty significant, because if we look at their income statement, we can see they did 21 or $2.1 billion in revenue. So that's more than 10% of their revenue that's just coming from their parent company that they have this contracted place. Now, as a shareholder of Telus International, the good news is you do get access to that revenue and the resulting profit that comes with it, which is a benefit of being a shareholder of them. And they did mention also in this report that this is a 10-year agreement. So it's agreement that's in place for 10 years, the master services agreement. So that provides you a bit of additional security, because before, when we talked about the debt being a little high, you're not as concerned with that if they have this long-term contract in place, which we can hopefully assume they're going to keep, and it's not going to get canceled later on. It could get canceled. It's not a full guarantee for the full 10 years, but that does provide some security because the interest that's associated with the debt that they have to pay is going to be well covered by that amount. But this does go back to what we're talking about before about how concentrated their client base is. But if it's concentrated, the real only risk of that is if one of those clients leaves, which, based on what we can decipher from this, it seems pretty unlikely that Telus, the parent company, would back out of this master services agreement with Telus International. But again, it could happen. It's not a guarantee, but it seems unlikely in my opinion. Okay, so now we've covered who this company is, what they do. We've gone a little bit in depth on certain items and their financial statements. Let's talk about the industry. Now, generally speaking, you want to be invested in companies that are in growing industries because, by and large, those are the companies that are going to outperform the market. So let's see if we can collect a few data points and make a case for this. So when you're analyzing a company, in my opinion, you have to be able to answer the question, what needs to happen in order for this company to be very, very successful? And in my opinion, with this company, the answer to that question is company executives need to place greater importance on enhancing their digital presence, digital customer experiences, and utilizing more emerging technologies like artificial intelligence, robotic process automation, and the like. Now, when I say company executives, I mean company executives of companies that Telus International would be selling to, because ultimately those are the key people in the business that are going to have the final say in what type of purchase decisions their businesses make, the key executives in the key positions. So you're going to be looking for chief technology officers, chief information officers. They're the ones that are responsible for overseeing what type of technology a company decides to implement. So if a company wants to start utilizing more of these emerging trends like artificial intelligence or enhance their digital customer experiences, and they also decide they may need some consulting help in that, they're going to look to companies like Telus International. So you need more of that to happen in order for this investment to work out in the long run. So what type of data can we look at that would lead us to believe, or maybe give us more information on that trend specifically? So I found this research report here. It's from Deloitte, which is a reputable company. And they're basically just talking about how companies are placing a greater emphasis on what they call hybrid experiences, which is a combination of digital experiences and physical experiences, like an in-store purchase, for example. And what they're reporting here is they're saying companies are interested in investing more in these hybrid experiences. And then more specifically, they're saying 43% are looking to increase personalization. So that is something that, in my opinion, would bode well for Telus International, because a lot of these emerging technology trends like artificial intelligence, content curation, digital customer experiences, that whole laundry list, those relate to personalization. Companies want to be able to offer more personalized experiences for their customers because customers are starting to demand that more. So what this research is telling us is 43% of key executives are focused on that, essentially. So that is one data point we can look at that helps us build a bit more of a case for this. And then they talk about a few other things like innovation is also important, customer connection, which in my opinion, that goes pretty much hand in hand with the personalization. And then here's a graphic on the data there. So to me, this is some of the type of background research you can do in the company. This wouldn't be all I would try and do. There's always more research you can do to help build the case more, but it's something that you can look at and say, okay, I'm starting to understand this industry a bit more, which, if you're an average retail investor out there, you don't have the luxury of unlimited access to information like some large reputable funds might have. So you have to make do with what's available to you. So in my opinion, doing this types of thing can help. Okay, so our last step is now to tie all of what we've talked about into a valuation. And this will really help us build an investment case for or against this company. And because there's a lot we can talk about with this company, but at the end of the day, if the price isn't right, then it is going to be a pass for me. Now, this one valuation I did find pretty difficult to do because it's difficult to get any sort of certainty with these numbers particularly. Now, I mean, any company out there, you're going to have trouble determining exactly what the future for that company is going to look like, even the most predictable businesses. But especially for a company like this that is so new, it does have a very uncertain future. So a lot of my assumptions are probably going to end up being wrong. But what I'm trying to do here is I'm not trying to pull out a crystal ball and project the future. I'm just putting in numbers and then determining what type of an investment return we can expect given those numbers. And then once you know that, you can take a look at those numbers and say, okay, given what I know about this company, do I think this is reasonable or not? And am I willing to bet on this company achieving those numbers? Is it worth the risk, essentially? So I'll go through the assumptions I made here. So the first one is revenue growth. So I gave them a 25% revenue growth rate for the next 2 years. So this will put them at about $3.5 billion in revenue for the full year of 2023. Now, revenue growth in the years after that, I've had it taper off a bit to 13.5%. And the reason I have that is because that's really the rate of growth that's expected in the whole digital customer experiences market. Again, it's really just an assumption. It's not something that I put too much thought in, tried to just put in something that was reasonable so I could see what the output is. And then their operating margin, I went off of what it's been historically, which is about 10%. And then I also assumed as their revenue scales up, they will see some cost efficiencies get realized. So their EBIT margin or operating margin will expand slightly by 0.25% a year throughout this model. And it is a 7-year model, 7-year discounted cash flow model. And then the tax rate I have at 26.67%. Perpetual growth rate. So in the years 2028, I put at 1.5%. Cost of capital, which is calculated in this tab, which I'll attach this spreadsheet to the description of this video in case anyone wants to take a deeper look at what I did. I know some people are interested in doing that type of thing. And then their shares outstanding. And then I also assumed slight dilution in the shares outstanding because they do offer share-based compensation to their employees, which will naturally result in some share dilution. Now, share dilution could increase a lot if they decide to make more large acquisitions, which does seem likely based on what I can tell about this company. Acquisitions are going to be a big part of their strategy going forward. But for the sake of this model, I'm really just assuming organic growth in the business. So we have their revenue here. We're basically projecting them to get to $6.5 billion in revenue by 2028. So that is pretty optimistic in my opinion. Again, it could be very reasonable, but it is also optimistic. And then we deduct taxes. We also deduct capital expenditures, which I just put a general estimate there based on what it's been historically for the business. Now, one thing I do want to point out is depreciation amortization. Now, as I discussed previously, acquisitions are going to be a big part of this company's strategy. And when this company acquires another company, it's probably going to be a tech company. And when you acquire a tech company, there are certain rules. Again, this goes back to accounting rules. There's certain accounting rules that the assets that you acquire from that company, specifically the intangible assets, so things like software, even research and development, if they meet certain criteria, then they can get recognized as intangible assets. And intangible assets get amortized over their estimated expected useful life. So how long they expect that asset to provide an economic benefit to the company. Again, not going to get too deep into the accounting details, but because acquisitions are going to be a big part of them, and those acquisitions are going to be tech-related acquisitions, I expect amortization expense to go up quite a lot. And because it's a non-cash expense, we add it back when we're calculating free cash flow to firm as part of the DCF model here. So skipping to enterprise value, I get about 12 billion in enterprise value. We then add cash, which I just did a general estimate for that. We deduct debt, so I assume the debt is going to increase to $2 billion by 2028. They have no preferred shares, so this gives a 10.4 billion value of the equity. Divide that by the shares outstanding, and you get a fair value per share of $38, with a current price of about $32.50 as of recording this video. So the fair value, or projected fair, or the current price really as a percentage of the fair value, that's what this should say here, is about 85%. So we're basically concluding off of those assumptions, which are just assumptions, that this company is slightly undervalued. Now, what our return off of that would be, again, if you believe these numbers, would be just under 10%. Which really isn't that great of a return. I mean, you can get generally between 7 to 10% holding a diversified index fund into the long term. Now, ideally, that's what it's done historically. It's not guaranteed that it will do that in the future because the past 50 years are probably going to be pretty different than the next 50 years, which, well, that's a whole other conversation I won't get into. But in my opinion, I think if you're only projecting a 9% return, unless you think that these assumptions are very, very conservative, then it's probably should be a pass. Now, again, what happens if we bump up these assumptions? Like, let's say instead of 13.5, they just go 15% revenue growth for the years 2024 to 2028. How does that impact our return? Well, it goes up by about 1%. So now we're at 10.5. And let's say it goes even higher than that. Let's say it's 20% revenue growth. So still 25% for the next 2 years, 20% the years after. Now it's much more of an attractive return, 13%. In my opinion, now you're in the territory where, okay, this company is decently undervalued. We could say it's it's trading at about 60% of our calculated fair value. But again, you got to play around with the assumptions, and everyone is going to have their own opinion on this company, depending on what you believe and what you think is reasonable. For example, maybe there's a bit more dilution, which will lower your return because that means that enterprise value that we calculated here, or the value of the equity rather, is getting split up amongst more shares, which means the value of each individual share goes down. So your return is going to go down. So you see it went from 13.4, I think, to 13.1, so a little bit there. But you get the idea, right? So this is what I was talking about at the start of the video, where you've got to decide for yourself what is reasonable. My goal is to do this type of analysis and show you that it is possible and show you what kind of results happen when you enter certain numbers. Okay, but in terms of a conclusion for this company, I am going to say for me, this company is going to be a pass, just because based on the research I did, I didn't really get intrigued that much by it. There wasn't that much of a compelling case. To me, this just seems like your average IT services company that it could probably do pretty well going into the near future, but there wasn't really anything that I found based on what I looked at that really made me want to dig a little deeper into this company, because I saw something that could be a lot more interesting. But again, people may disagree with me. That's just my personal opinion, but I hope you guys did enjoy this video. If you did enjoy it, then please leave a like and subscribe. If you are new to the channel and you enjoy this type of content, I got much more videos like this planned, and I'll see you guys in the next video.